6 thought leaders in today's financial markets will discuss their take on the economy and their outlook for the financial markets. Round Table Prime will divide the discussion into 3 segments. The roundtable guests, with decades in the financial markets, are recognized leaders in macroeconomic analysis, market research, and investment management. They bring together a broad array in different sectors of the financial markets, including government fixed income, credit, equities, real estate, and commodities. All have been sought after for their insights as speakers and as commentators in the financial media. And now, DoubleLine is pleased to introduce the honored guests of Roundtable Prime, our moderator and our host. Jeffrey Sherman will moderate today's discussions. Jeffrey Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager of a number of DoubleLine's fixed income and derivatives-based strategies. He also hosts the Sherman Show podcast series, which has featured many of today's distinguished guests. Ed Hyman is chairman of Evercore ISI, where he heads the economic research team. For the past 44 years, Ed has been ranked by Institutional Investor Poll of Investors for Economics and ranked number 1 for 39 years. Ed Hyman is highly regarded for his origination of econometric modeling and real-time surveys to gain insight into the unfolding business and market cycles. James Bianco is president and macro strategist at Bianco Research, which he established with the aim of originating insights unencumbered by traditional Wall Street research. His commentaries address such diverse subjects as monetary policy, the intersection of markets and politics, fund flows, and asset allocation. Jeffrey Gundlach, host of Roundtable Prime, is founder and CEO of DoubleLine Capital, an investment manager with investment strategies in fixed income, equity, real estate, and commodities. In 2012, 2015, and 2016, he was named to Bloomberg Magazine's 50 Most Influential. In 2017, he was inducted into the FIA-SI Fixed Income Hall of Fame. David Rosenberg is Chief Economist and Strategist of Rosenberg Research and Associates, an economic consulting firm providing analysis and insights to help investors make well-informed decisions. Prior to founding the firm, he was Chief Economist and Strategist at Gluskin Sheff and Associates. From 2002 to 2009, he held those positions at Merrill Lynch in New York, where he was consistently ranked in the Institutional Investor All-Star Analysis rankings. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine, will now open the first of 3 segments of Roundtable Prime.
All right, everybody, welcome to the 3rd edition of the Roundtable Prime here live from the Los Angeles office at DoubleLine. As Jim was reminding me, we've had a live version, we've had a completely remote version, and now we're having a hybrid version with our guest today. So thanks, everyone, for taking the time to make it and join us today. What we want to start off with is what's on everyone's mind, and that is what is going on in financial markets. And let's look at dig into some of the economics data. So our first segment is really going to focus on what's going on from the macroeconomic standpoint, and then we'll transition to markets. And lastly, we'll talk about how to execute on some of these ideas. So starting off with the macroeconomic landscape, Jim, why don't we start with you? You're a big Fed watcher, as I've seen you be attributed for. And the mantra in my career has always been, don't fight the Fed, right? And so the Fed's been extremely accommodative, right? We know with the QE policies, very ultra-low interest rates, very aggressive in both of those in the pandemic. So does the Fed still have our back? Because the Fed is now transitioning from the quantitative easing standpoint to tapering their purchases. Rate hikes are on the table. Bond markets are going to price those in. So what do you see with the Fed doing in 2022? And should investors try to fight the Fed? Should they welcome the Fed? And where is the Fed put today?
Yeah, it's a good question, by the way. Thank you for having me, because there is a dynamic that's changed in the last year or so that makes it a little different than what we've seen over the previous 13 years. That dynamic is in political polling. The majority party, and I want to say that in a nonpartisan way, because if it was the other party, it'd be the same, is not polling well. And when people are asked, what are the biggest problems in the economy, prices and inflation are now replacing COVID is number 1. 40% of the country rents and has less than $1,000 of savings. They are very unhappy about inflation. So now the Fed has got an interesting juxtaposition, because in the past, whenever they would deal with financial market instability, you supposedly had both sides on the same camp. If you pumped up markets, everybody was happy. If markets went down, everybody was sad. Well, now you've got a position where if you address what the 40% want, you might make markets unhappy. If you acquiesce to markets, you might make the 40% unhappy. How do I know this? Because we are getting stories, several of them, as a matter of fact, that the administration, for the first time since Jimmy Carter, is asking the Federal Reserve to get more hawkish. Do something about inflation. The Fed told us for a dozen years, going back to Bernanke's famous 60 Minutes speech, we have the tools to deal with inflation. We could deal with it in 15 minutes. Okay, it's here. You've got the tools. Use them, is basically what they're being told. So they're in a tough spot because that's the other side of the equation. It isn't just, pump up markets and everybody will be happy. Or if markets fall, everybody will be sad.
Yeah. So I told someone that too, when you talk about that they have the tools to do it. They could. They could hike 300 basis points. They could hike 400.
You could have a Saturday night massive.
Yeah,
right? Yeah. It could
you
be.
Want me to end inflation? Watch this, right?
Yeah.
Right. It's funny. For years, I've given speeches, and the question would come up: Is it even possible to get inflation again? And I would say, well, of course it's possible. You have to sort of want it. You have to sow the seeds. And I said, I can guarantee you, I can get inflation by 5 o'clock this afternoon. And I do this hyperbolically. I say, we have the Treasury Department and the Fed in cahoots, and we send $1 billion to everybody's bank account at 4 p.m. And if you don't have inflation by 5 p.m., the lines at the Ferrari dealers will be something to behold. And of course, that's very hyperbolic, but that's sort of what we did. I mean, if you're an intelligent 12-year-old, you'd be able to say, if you curtail productive capacity while simultaneously spraying trillions of dollars, do you think prices might go up? And this is just another example of the Fed being embarrassed. Remember, subprime is contained. Inflation is transitory. It's like, you couldn't see this coming? I mean, Sherman, in the MAG inflation model back in January of last year, we were saying we're as hawkish as anybody out in the market on inflation because we think it might actually hit a 5 handle.
Yeah.
Well, it's going to hit a 7 handle on the next print. So yeah, you're absolutely right. It's to the point where the inflation is not being received favorably by a very large percentage of the population.
Yeah, and so Danielle, when you think about this too, a lot of the rationalization's been, well, hiking rates isn't going to cure supply chain problems, right? How does that change the containers out off the Long Beach port and the likes? So talk me through how the Fed thinks through this, right? How they get to that point, whether or not you agree with it. I saw the head movement there, but as you think about it, how does it get through their psyche to say, okay, hiking rates really helps us here, even though some of these things are really exogenous or beyond their control, at least in the short to near term?
So I think I'm actually going to agree with Fed officials when it comes to the supply chain in large part. We've seen the Baltic dry come way off of its highs. We're seeing companies stockpiling. We don't know what the effect of stockpiling is going to be. We don't know what the effect of just in time to just in case is going to be. But we are seeing delivery times come way down. We're seeing that part of inflation that Jay Powell insisted would be transitory begin to become transitory. But that's neither here nor there, because the sheer amount of fiscal stimulus that was injected directly, as Jeffrey said, into the economy. You're not kidding about the Ferrari lines. The day I was at Highland Park Village, the day that it's the Rodeo Drive of Dallas, Texas, the day that a Rolex store opened, it sold out within an hour.
Maybe it was just smash and grab.
No, but there were lines around Fendi, there were lines around Christian Louboutin, there were lines around Chanel, there were lines around Hermes. So the bifurcation that Jim describes is so acute right now that the Fed has put itself in the worst position because the fiscal impulse was so massive that helped the lowest end of the income strata. And obviously the highest end has been helped as never before through Fed policy, filtering through that 1%. But it's the 40% that Jim points out that are stuck in the middle who are really paying this inflation. They're not getting, let's call it a family of 4. They're not getting $1,100 in child tax credit in cash. They're not getting more than $1,100 with the October the 1st increase in supplemental nutrition assistance program benefits, what we used to call food stamps. But your average family who qualifies for both was getting $2,200. University of Chicago did a study. 1.5 million spouses fell out of the labor force because they were getting so much in fiscal support that it made economic sense for one to drop out of the labor force. So Fed policy has managed to create wage inflation that's going to be sticky because so many people retired, rental inflation that's going to be sticky. That's your biggest line item. And as Jim just said, 40% of Americans rent. And these are the people in the middle of the income ladder that are being slammed. And they're calling their politicians. They understand what's happening. The people at the top don't care. The people at the bottom don't care as long as nothing changes. That's what makes Joe Manchin the most important man in America today. Because he's the moderate in the middle who's trying to make sure that we step back and say, this is a little bit of fiscal insanity. We need to see what effect this has had. And the effect it's had, coupled with Fed policy, is real inflation, where it hurts the most.
Yeah, well, you bring up the impulse, right? The surge in really just money being sprayed everywhere. And when we think about impulses, there's base effects, right? And so a lot of these impulses, they occurred in 2020. Right? So we've seen some of that roll off. So Rosie, let me take it to you, to our neighbor in the north up there. And how do you think about these fiscal impulses here on the U.S. economy too? Because I know from your perspective and your writings too, that you think a lot of this stuff is already working its way through the system.
Right. Well, look, the way I look at the situation is that when you see the inflection point in the inflation data, it didn't come in 2020, and we had tremendous fiscal stimulus at that point as well. The real inflection point was in March and April, and you had two things happening. You had Delta, which was a crushing blow on the supply side globally, and keeping in mind that the U.S. is a huge importer, and how this had a major distortion on supply chains, especially in Asia. And that created a massive supply shock, just as we had that gargantuan fiscal stimulus package out of the administration. So if you take a look at the data, the big inflection point was really March and April, and then we've accelerated ever since. But we can explain it. And there's nothing here that says it's going to be permanent. We can understand we had massive fiscal stimulus bumping into a supply shock. And you can almost look at this very similarly to what happened after World War II ended, where we had a couple of years of massive inflation. In fact, inflation got to 12% temporarily because the rations came off more slowly than the troops coming home creating the demand. We had 2 years of rampant inflation. And of course, this is a war against a health crisis, and that was, coming off a real world war. But you could explain it then, like you could explain it now, that there were some, I would say, still transitory supply and demand forces at play. I would have rather that instead of the Fed using terms that it then regrets, is maybe just end up defining or trying to define what transitory really means, because I frankly have no problem with the view that if it's a couple of years in the overall context of economic and financial history, that is transitory. The key for the Fed is to make sure that inflation expectations don't get out of control. And there's really no signs that inflation expectations are really getting out of control. And one of my favorite indicators is the 2 to 5 year University of Michigan inflation expectation metric, which has been stable at under 2.5%. But the Fed, and I think Jim is right, that certainly the Fed has to sound very tough now on inflation. What they end up doing, who knows? I mean, they barked like crazy. They were going to raise rates 4 times in 2016, and Janet Yellen ended up raising rates once. So we'll see what ends up happening. The course of events will dictate that. But my major point is that I can't put this at the feet of the Fed any more than I can put this at the feet of Japan. Has the BOJ been any less accommodative than the Fed has been? The answer is no. You can argue they've been more accommodative, and underlying inflation in Japan is close to zero. So, it's hard for me to wrap my head around the Fed. The Fed, to me, the mistake, if the Fed made a mistake, it's that QE is just there to juice up financial assets, and they've created a monster across all the risk asset classes. That to me is going to be the big risk, and then the second round impact on the economy, and then on inflation. If we end up having these bubbles burst, and we've seen the Fed do this before. So I lay at the Fed, not the consumer inflation, but the massive financial asset inflation that we have in our hands. I think these are the biggest bubbles I've seen in my lifetime. The fiscal policy, though, coinciding with what was happening with the virus and the supply side, that created this massive inflation disturbance, and it's been a disturbance. But what do we know about next year? We know there is no more fiscal stimulus. Let's not talk about the inflation that's already happened. We had almost 6% inflation back in the summer of 2008 when we had that Chinese-led commodity bubble. And then a year later, inflation is running negative year on year. Nobody called for that. What do we know about next year is that the cyclically adjusted fiscal deficit is going to contract 4 percentage points. In the past 40 years, that's never happened before. We're going to have fiscal drag, not fiscal stimulus next year. And then the question is, what is the impact that's going to have on your GDP forecasts? And then if everybody is right that the Omicron is just basically something mild, that we're going to morph from a pandemic to an endemic with obviously positive benefits, but the benefits will be more to the supply side with a lag. So my sense is that let's see what happens. We're finishing, we've had 3 years of incredible monetary stimulus that started at the beginning of 2019, and that's going to be shifting in the coming year. And we had unprecedented fiscal stimulus in these past 2 years that went overboard, but that's not continuing. So if the fiscal stimulus that caused inflation is not continuing and the Fed is shifting gears, why would you therefore believe that inflation is going to be a permanent problem, even if transitory might not be the appropriate term? I think the risk, I think that what most people are missing is how quickly inflation is going to fall in the second half of next year. And the other thing I'll just add this, because Danielle brought up the rental side. If you take a look at what's happening in multifamily permits, starts, units under construction and completions, and there's lags involved here, we're going to be faced with a deluge of rental supply in the second half of next year. And that's when this rental story, which has some more legs for the next few months, but I mean, come on, who doesn't know that? What people don't know is they're not looking at the rental supply data. They're not looking at the units under construction, which are at a 47-year high, and the impact that's going to have on vacancy rates and rental rates in the second half of next year.
All right. On that note, too, Ed, as you think about this, we've been talking about how accommodative the Fed has been. That was coupled with all of this fiscal stimulus. We talked about these risk assets being very in vogue and asset owners doing very well. Where does this put you in thinking about the overall U.S. stock market?
Well, I want to back up a little bit first, okay?
Please.
I don't know where I'm coming from, but Milton Friedman, made a big splash by claiming that the Depression was caused by a 30% drop in the money supply. 1963, 30 years after it happened, he pointed that out. Well, M2 in the past 2 years has increased 40%. And you can take a look at it weekly, bank deposits. And as of last week, they're still going up like crazy. And bank loans in the past month, which is the transmission of velocity, they're growing at an 18% annual rate in the past month. So it's pretty clear to me that we have a theory that inflation is a monetary phenomenon. We have an extreme amount of money been pumped in the system on top of what Jeffrey talked about, the fiscal stimulus. But moving on, because I think, David, you're absolutely right, that's old news now. But then you also see that this money is impacting the economy everywhere, whether it's art prices, real estate prices, stock prices, employment, wages, rents. I mean, I can't think of pizza. I can't think of hardly anything that's not being impacted. So I think that the surprise this year is that this year is going to resemble last year. Inflation is going to be a problem. The way that the view of Fed watchers had to move to a more hawkish Fed, that's going to happen again this year. And so that's I've really come to this in the past maybe 8-10 days when I started looking at the 2-year change in the money supply and seeing bank loans accelerate. So that's my feeling. Now, that money is pushing up everything. You name it. Rolex watch prices, or Rolex sales in Dallas, or you name it. But also, every piece of work that's been done finds that the money supply for monetary stimulus leads by about a year and a half. 1923, John Maynard Keynes said the money supply leads by 16 months. I don't know how he got the 16 months, but so I think we got a lot of fire in the hole here that's going to keep the economy going. And in terms of the stock market, that's part of the economy.
One thing that's really interesting, Ed, is you talk about that money supply growth over the last 2 years, and it's obviously been very powerful. One thing that is an interesting juxtaposition against that fact is that the S&P 500 is up about 30% from the end of 2019. It feels like it's more because you feel, but there was that huge drawdown into March, April of 2020. But if you take out 5 stocks of the S&P 500, the FANGs, Facebook, Apple, Amazon, Netflix, Google, the S&P 500 is up 0 without those 5 stocks.
So I'm going to throw something in here. If you
No, go ahead, Ed.
If you take out my 5 worst forecasts, I'm a genius.
I love it because I always say, when you do a review with a client, they always want to talk about what's down.
So I actually want to validate Ed's point. So if you look at M4 growth topped out at 30.6% in June 2020. It's since dropped down to 5%, and that's a November print that came out on January the 3rd. This is pre-taper. So you've actually seen with an 18-month lag that pan out and manifest in stock market returns because that the growth of the money supply that peaked out in June of 2020, that's since fallen to 5%, is going to fall further, and that's why we're seeing, generally speaking, there's been a little bit of a steepening to start the year out, but that's why we've seen the flattening with the rapidity that we've seen it in the yield curve. It's because the growth of the money supply has come crashing down. But to Ed's point, there's definitely been this 18-month, 5-quarter lag.
Yeah. Well, if you think about it, and I'll take this one to you, Jim, and you think about what's happened with all this money supply and all the growth out there, and then we look at the reverse repo that's sitting at the Fed. Right, we've seen a huge drawdown last week or so. I know you watch this very closely, and it was a harbinger of bad things to come back in 2018, right, where people were parking money there. But to Ed's point, this loan growth, right, banks weren't making a lot of loans because we were all awash with cash. Whether it's the consumer, corporate America was able to borrow very easily and cheaply out there and extend out maturities extremely long into the future. So what do you make of what's going on in the repo market today? And is there something that people are missing here? And is that going to bring more loan growth as we think and we move further into 2022?
Yeah, I think the simple answer with what's happening in repo is that the banking system is awash with money and they don't know where to put it. And the Fed is here promising you 5 basis points, no questions asked. And a lot of it is going into repo. And by the way, the indications are, because there's no hard data, that about a third of that is the top 4 banks. So it's very heavily weighted towards the JP Morgans, the Citis, the Wells Fargos, and the Bank of Americas as well, too. So that's where they're parking a lot of their money. Where it goes to is this idea that we've talked about here a little bit, is this money's not making its way into the real economy to the extent that we want to, but it is making its way into financial assets. And if it's going to help to depress interest rates, if it's going to help to keep the liquidity going, you're going to continue to see it push up financial assets as well too. And one quick thing about financial assets, I want to add to what Jeffrey said. So if you take out the FANG stocks and the market hasn't done anything since the beginning or end of 2019, there's a narrative that the stock market's up a lot and it's telling you that everything's okay. What's that narrative when you take out the 5 stocks? That narrative, it's not that it's bad, but all of a sudden the story gets a lot muddier at that point as to whether or not financial markets are validating some idea that we're going to have very strong growth because it's so concentrated in just a handful of names. And lastly, if you go to the next level down, look at the Russell 2000 small cap index. And there's an argument to be made that is a better indication of economic cyclicality. Those stocks are actually down from where they were in early March right now. They're barely up from where they were in 2019 as well, too. So what's the message of the economy if those stocks are not really moving forward? And the last statistic I'll give you on this about how upside down everything is, the Russell 2000 is a total market cap of about $2.4 trillion. Apple's $3 trillion. Yeah. Apple is larger than the entire small cap universe, which is unusual to say the least.
That just lives right in parallel with this sort of medieval feudal society that we've turned into, where you've got, Danielle said it earlier, which is exactly right. You've got, and you did too, Jim, you've got like some people that are doing outstandingly well, and then others that are sort of in a safety net that's being created by those doing outstandingly well, and we continue to hollow out the middle. And I know you mentioned that the large banks and their influence in the money markets. I know that probably triggered Danielle.
I mean, the sheer amount of power that's been assumed. Everybody thinks that Jay Powell had his existential crisis kind of in late 2018 when the markets were just bleeding down and there hadn't been a high yield bond issued for 41 straight days. I think Jay Powell's real moment of truth came during late 2019, basically when the biggest banks in the country, led by the biggest bank in the country, had him by the short hairs and said, if you really want me to show you what my power is in the markets, let me show you what a repo rate can do. Let me just give you a little bit of an idea of how powerful my balance sheet is versus your balance sheet. And it's with good reason that we now have a standing repo facility that is obviously not engaged, but it's something that's standing there because under Jay Powell, he's ensured that that will never, ever happen again, because it was not QE that got us started down the path towards QE itself. And it was not QE that got us to the point where we were howling for reserves because currency in circulation and quantitative tightening were going on in the background at the same time that Powell was trying to normalize. So it was a cascading effect, but that's what affected Jay Powell more than the credit market seizing up.
Yeah, I want to point out that I'm thinking like a money manager. I use the phrase reverse repo. It is a repo facility, so both of you correctly have said that correctly to me. As I think about what you're talking about, the feudal society and everything, there's been all of this focus on this labor shortage, right? And I'll let anyone jump in on this as well. We've seen participation come down, the replacement of workers, early retirees. Is this going to ultimately continue to put pressure on wages? We got new JOLTS data today here on January 4th, right, where we see
a lot of quits
out there, a lot of people going to new jobs. So, Jim, you're chomping at the bit. Rosie, I'd love your take on this as well. So let's talk about the labor market. Start us off, Jim.
Let me posit something, and I'd like to hear everybody's comment on this. The biggest event of this generation was we sent everybody home for now nearly 2 years. It has changed a lot of things that we don't understand. There is a perception on Wall Street that, if X happens and Y happens, we're going to go back to 2019. We're not going back to 2019. I'm not saying it's going to be bad. I'm just saying that whatever is the new environment for work, whatever the new environment for the office is to be determined. And I think when we look at these quit rates and when we look at the change in the labor market, that labor has more control over management, over wages and everything else, that there is a fundamental change that's going on in the economy. So when we talk about what's going on in labor, I don't think any of us know what's going on in labor. I just think we ought to start with, it isn't 2019. It isn't going to be going back to 2019. We're here in downtown Los Angeles. I live in downtown Chicago. I don't know when we're going to get back to the point where you're going to have to wait 20 minutes at the Chipotle across the street to get lunch again, if that's ever going to happen.
There isn't any Chipotle across the street anymore. There's nowhere to get anything to eat down here.
The ecosystems around urban centers have been decimated.
And that's why, so what I wanted to say was, I think things have changed. I know those are dangerous words to use in the financial markets. This time is different. Yeah. But we sent everybody home for 2 years.
We did.
And that has changed things in ways that we don't really understand.
Well, again, when you add the 1.5 million spouses that we know have dropped out of the labor force because the fiscal safety net has been widened to the extent it has, to the 3.5 million early retirees, you get to this round 5 million number. In November, we had 4.5 million people quit their jobs. So you have this massive slice who's dropped out of the labor force that has empowered the skilled laborers who have stayed in the labor force, because at the same time we're seeing job openings begin to decline, and in fact at a dramatic pace, which means that we're likely at full employment. So if you have a job and you have skills, you are employable and you can hopscotch all you want to the next higher ticket. But if you've been out of the labor force for 2 years, nobody wants to hire you. And at last check, according to Senator Manchin, there is no child tax credit that's being sent out on January the 15th. That's gone. So there is going to be a shock to a lot of the lowest income earners in the very beginning of this year. And in addition to that, the IRS begins to accept applications for income tax refunds on January the 31st. That's the day that the window opens. So a lot of these, especially lowest income families, are going to go and expect that couple $1,000 tax refund that they're going to have. Somebody's going to have to explain to them that they've actually been taking that credit in cash since July of 2021, and ergo, their refund isn't what they expected it to be to pay off their Christmas card debt, credit card debt. So there's going to be a lot of disruption surrounding that 1.5 million spouses who've dropped out of the labor force in January.
Yeah, I want to go to Rosie on this too, because I'm listening to Danielle talk about potentially being at full employment. We all have this debate on whether there is a Phillips curve or not, but it's always been the thesis of the Fed, hence the dual mandate, or since the dual mandate, right? It's the only way they work together. So, Rosie, walk me through your thinking on this too. What do you think about the U.S. Labor force, and are we there? And does that materialize in some form of inflation that we're not seeing yet in the data?
Well, look, I don't know how anybody can make a full assertion that we reached full employment. We're still in the pandemic, and we're not going to know, even to Jim's point, how close we come back to the old normal or not. We're not going to know for a long period of time. So it's just guesswork and pure conjecture. Let's just say that in the last cycle, people were talking about labor shortages, and they were talking specifically about the inflation that Donald Trump was going to create, not just through tariffs, and not just through tax cuts to stimulate aggregate demand, but also his restrictions on immigrant labor. And we got to a 3.5% unemployment rate before COVID. And I seem to remember being at the inaugural summit 2 years ago, and everybody talked about inflation and wage inflation back then too, 3.5% unemployment. We hadn't seen that in 50 years, and everybody had inflation on the brain. There was a period of time for many years, by the way, after World War II, where the unemployment rate was 2.5% for a sustained period of time without there being any meaningful wage inflation. So it's just pure academic guesswork, and especially now that we're in the pandemic, to suggest that we're in a sustained period of inflation or wage inflation. The price will always tell you the truth. You hear people talking about the explosion of wage growth. The Atlanta Fed wage tracker is the gold standard and a leading indicator. And it's showing actually that the only wage growth outbreak that you're seeing is among youth in leisure hospitality, unskilled, uneducated, barely more than 20% of the workforce. And everybody is going absolutely hysterical. The answer to the question is that we don't really know. I don't buy into the great retirement theme, because when you actually look at the data, you look at the data from the Fed survey of consumer finances, you're going to see that the median household has maybe 2 years of a 401k plan they can burn through before they have to come back to work. That's between people ages 45 and 54. This great retirement, smell the coffee, it makes for a nice report, and it gets in the Wall Street Journal, but we don't know. People are saying they're retiring now, and then they'll come back in a year. But what I'll say is this, and it's just the facts. The labor force participation rate peaked in 2000, and it's gone down since. Not a straight line, but it's gone down since. It peaked in 2020, just as the boomers were hitting Freedom 55. And I don't remember from 2000 to say 2019, a 19-year secular decline in the participation rate necessarily led to an acceleration in wages or an inflation. But I think that certainly, if you have an inflation bias, this certainly fits your view, so you'll run with that narrative. I don't see a lot of proof, and we don't know, once the pandemic is fully in the rearview mirror, how many of these people, come back in to the labor force. And then it comes down to how you want to define transitory. I said before, I might be the only one on the planet that has no problem with transitory being 2 years. I think today's investor and economist and strategist have narrowed in their time horizons to like 2 months or 2 quarters. But that's not me. So I think that, that's where I fall out of the situation. We talked about the JOLTS data that came out today. When you're taking a look at where are the quits are accelerating in leisure hospitality. Okay, they're job hopping, sure. They're in demand, they're job hopping and going to get much better than minimum wage. I get that. Is this economy built on leisure hospitality? I mean, please give me a break. And the only other sector that's seeing a real breakout in quits is healthcare, and for good reason, healthcare and education, because they're basically burnt out. But once again, once we're past the pandemic, I think we're going to find the participation rate might not get back close to where we were pre-pandemic, but it's going to go back up. And depending on what employment growth does, there's a good chance that the unemployment rate doesn't go back down anymore. It starts to hook up next year. Something that nobody's really considered. That if you believe the pandemic is going to end, and I think we have to make that assumption, the participation rate's probably going to be rising. And in conjunction with where employment growth is, the Fed might be surprised next year that the unemployment rate goes up and doesn't come down.
Okay, so Rosie, I'm gonna agree with every single word that you just said. Full unemployment does not necessarily mean that there's wage inflation that's percolating around. I'm concerned that there's been an accelerated level of automation in the economy, and that a lot of the jobs that are going to be desired are not going to be there. We're 8 million jobs below where we were pre-pandemic trend in terms of job creation. So there are a lot of jobs that have not been created since the pandemic first struck. And I'm actually agreeing with you that a lot of people are going to try to reenter the labor force, but find out that their jobs have been automated out of existence, or that major hotel room chains, I've traveled the country this last 12 months, every 3 days, if you're lucky, then you can get your room serviced or not. You can make your own bed. So a lot of companies have adapted their cost structures, and they will never go back to the same level of labor costs as they had before. I'm not suggesting that all of these jobs are going to necessarily have demand behind them, which is why we saw the number of job openings decline.
I want to go back. Rosie brought up one of my favorite themes, which is the Atlanta Fed wage growth tracker. And if you break it into cohorts, it's true that it's just the young people that have really had very high wage increases. That's always the case, by the way. It's always higher than the older cohorts. But it's running at 9.7% for the 16 to 25 category, 24 category. And interestingly, until recently, the other cohorts, ages 25 and higher, and particularly 55 and higher, had lower year-over-year wage growth than they had in 2019. And that's kind of interesting. That's just the one area. But that has changed in a way that's not yet convincing. In the last, say, 6 months, every cohort, including 55 plus, has started to edge higher. And I think this is really critical to watch every single month, because that's really the wage inflation answer. will be if those other cohorts start to rise. And it's not at all clear, although thanks to the environment, you see this debate about minimum wage has disappeared because companies have had to pay more. I saw a Denny's a couple of months ago that said now hiring, all locations, all shifts, full-time, part-time, $16 an hour for entry level. And it said below that, which is what got my attention, supervisory jobs, $16.50. And I thought, that seems like a very small gap, right? And so you wonder if the 1650 doesn't turn into 20. Now, those are still probably in that lower age cohort, but it's just interesting to see if that's going to percolate further up.
Yeah. Ed, I want to get your take on the labor market too, because you've always taught me follow the money, follow where it's going. What are you seeing in the labor market and your thoughts on the wage growth or wage inflation debate?
Well, first, it seems pretty clear that we had some reduction in the supply of labor. And at the same time, you had a 40% increase in the money supply. So before I even delve into it, I'm thinking higher. But I'm pretty much a bottom-up observer. And the evidence that wages are going up is undeniable in every cohort. I think the biggest event last year would be that Deere settlement, where they got a 40% pay increase. And Jim, to your point, I was reading an article.
6%.
I'm sorry.
I didn't hear that was settled. I just heard that they had voted 90% not to accept the 6% wage increase. And I said to myself, what does that mean? If 90% vote no on 6, what do they want? And I used to conjecture, well, they want double digits. I didn't know they were going to get 40.
They settled for 40.
Settled.
Settled.
Yeah.
That's pretty big.
And then Target was advertising, to your point, 1950. There's an article in the paper about how other workers were saying, well, gee, we need 1950. Other people are paying more than that. But that's on the wages. So I think that average hourly earnings and the employment cost index will be key here. Next topic. Every week, we do a tally of layoff announcements. Been doing it maybe for 20 years. Last week, there were zero. There were no layoff announcements. And they usually run, 4,000 or 5,000 a week. So unemployment claims, as you know, went below 200,000, 52-year low. And I think they're going to go down to 150 because there are really no layoff announcements. And I'm beginning to think, unless the participation rate really goes up, that the unemployment rate is going to get into the twos this year, not next year, but this year. So obviously, if that was the case, now moving to a different cohort, we survey employment agencies every week. And last week, they told us that their business was the best on record. These are employment agencies. So this is more like 300,000 income, not $20. So I see lower unemployment, higher wages, pretty much everywhere.
Yeah, and we follow the unemployment claims. This is something that we'd looked at. We've looked at it for many years, but during the pandemic, seeing not just the initial claims, but the continuing claims. Right, we saw these exogenous programs that were out there providing incremental support to the labor market. And Danielle, you're talking about this, whether that's ancillary to what you're talking about, the SNAP program or other pieces. And so when you look at that, we see that unemployment claims are really hovering around their long-term averages, right? They're hovering around 200,000 per week. The continuing claims seems to have tapered off on average, right? We're running back to these pre-pandemic levels. So Rosie, what do you make of that?
Well, look, the employment is more complex than just looking at jobless claims or firings, which we know from the claims numbers and from the challenger numbers, and you could say from Ed surveys that that companies want to keep their labor, hoard their labor. We know that firing rates are extremely low. But what are hiring rates doing? So nobody mentioned today about how new hires are actually going down. And you could see that as well in the latest number of Challenger, because of course everybody focuses on the layoff announcements, but Challenger also does hiring announcements, and they've tailed off. So ultimately, employment growth is really the sum of two things. What are hirings doing relative to firings? Firings are low, but I'm getting a sense that hiring rates are coming down. And that's ultimately how you get to your forecast on employment growth. You can't just do it on one.
Okay, so let me take this concept of wages that we've been talking about and talk about one of the areas that's been problematic, and that's housing, right? You'd mentioned that a little bit. I think, Jim, you mentioned a piece of this too. But we're talking about wage growth, yet the younger cohorts are running at high single-digit growth. We talk about the middle cohorts just really aren't showing much. But I look at Case-Shiller indices, look at FHFA indices. They've been running year over year north of 20% roughly for a while now. We look at rents, whether it's the Zillow data, whether it's imputed rents, not from the Fed, of course, not from OER. But as you look at that, how does the worker survive this kind of area too when they can't keep pace not only with the asset price on the house side, but even the rent side of the equation seems to be really skyrocketing. And that's not just the year over year, looking cumulatively, let's say, since DEES-19, right? So, Jim, why don't you walk me through thinking about the housing market? Is it frivolous? Are we back to kind of different things we saw of the reckless behavior of 05, 06? It's a different kind of strata in there now. But what do you think about the housing market, and how do you think about its impact on the overall economy right now?
Well, a lot has changed in the housing market, in the pandemic. If you take the Case-Shiller data, you look at what they've called the COVID migration. Look at the home price gains in New York versus Miami. Miami is greatly outperforming New York, and that is everybody's moving, is what's happening. And you can see that in a number of places throughout the way that the housing market is changed. The other thing that's changed in the housing market is the prices. In 2002, 56% of the homes in the United States were trading at under $200,000. That category is effectively zero today, right now. You can't really find, I'm talking about new homes. You can't find new homes now that are being built under $200,000, at least at the single family level. So there's been another, like I said, when it comes to work, that we won't know for a long time what the new normal is, and it's probably not going to be 2019. I think when we talk about housing, it's something similar to that. We don't know what the new normal is for housing, but it's definitely not going to be 2019. But what housing has also done is, if you break down wealth categories at the very high end, they are enjoying gains in financial assets. Right below them, they are enjoying gains in their home price right now.
And there's typically more homeowners than there are necessarily stock owners, let's
That's
say. When you look at
exactly
ownership,
right.
Yeah.
And so when is my first comment about 40% rent and 40% of less than $1,000 of savings, and they're very unhappy about inflation. Well, right above them is a bunch of people that aren't seeing their paycheck keep up with inflation. But holy crap, look what my house did. So I'm okay with what's happening with inflation. And at the very top end, it's, wow, look at what my stock portfolio did. I'm okay with inflation as well too. So it's changing a lot of the dynamics in the economy as far as how I think that how housing is impacting it. And for the upper 60%, I think that they're okay with what they're seeing right now. But it also then does drive a bigger wedge in the inequality debate that we've had in the economy.
And Ed, let me come back to you, too, on that. What is your take on the housing market?
Guys, all this stuff seems self-evident to me. I mean, housing is explosive. I don't care. I mean, even Toronto is going crazy. Amsterdam, you name it. But every week we survey 40 real estate agents around the country. and ask them what prices are doing in their market. And prices are going up, actually going up at a faster pace, which surprises me. Not just going up, but accelerating. And so in 2021, you had house prices and stock prices go up, and commodity prices. And that trifecta was the most ever. Again, I keep coming back to something's going on that's driving through the economy or through Rolex sales in Dallas, if I can come back to that.
Well, I think what's going on underneath the housing market is the interest rates are so darn low. I mean, here we're talking about CPI inflation of around 7%. We're talking about Atlanta wage growth at 4.3%. And we've got the 30-year fixed rate mortgage closed the year at 3.25%. And so you have negative real interest rates that are below wage growth. I mean, why not? If your wages, if you have confidence that your wages are going to go up faster than what your mortgage rate is, it's basically free money. And you've got, of course, the supply it's right back down to basically the lowest level. It's like a couple of months, not even 3 months of supply. And so there's just such momentum behind the housing market that it just seems almost impossible that you would be able to see in the near term a reversal.
Yeah, Danielle, you're gritting your teeth.
I'm gritting my teeth. So if you look at people who are buying homes to live in them, to Jim's point about this mass exodus to the exurbs in 2020, 81% of home sales in the aggregate, existing and new home sales, went to organic buyers, if you will. That number crashed in 2021 to 74%. When we saw the last housing cycle percolate its way through, it took a long time for investors to get this big of a footprint that they have now of 26%. And they're not only buying homes that are existing homes, they're building entire subdivisions.
But isn't it, to Jeffrey's point, it's cheap money?
It's
right?
But it's absolutely cheap money. But from an individual buyer's perspective, they've hit their pain threshold, whether you're talking about new car prices, used car prices, or home prices. And a lot of it has to do with the fact that we've never seen an increase in the percentage of investors buying homes that we've seen in the year 2021. Well, there is no precedent at all. So, and they've got almost $300 billion in dry powder. So this is the first cycle that we've seen commercial real estate, private equity, dry powder bleed so much into single family residential that you could easily see momentum carry into 2022 with the absence of individual buyers who've largely stepped back because the prices are so high. But it doesn't matter because the Fed's created all this free money.
But doesn't that come back to cap rates?
Prices are high, but interest rates are so low that affordability is not much different than it was in 2004.
Affordability is the worst that it's been in years and years and years.
No, it's the same as it was in 2004.
The NBA data beg to differ.
Well,
Mortgage Bank Association. But again, it doesn't matter because there's momentum built into the system because investors are extremely aggressive with other people's money.
But to that point, though, if you're talking about an investor and you're talking about cap rates, right, what they try to earn on that property, well, if it's above the cost of borrowing, the NIM, the net interest margin, is there, right? So isn't that what we learn from the MPV game, right? That's what you're supposed to do. So isn't it really just a reflection of this low interest rate policy? I don't know. Rosie, let me turn it to you. You're the one in the Toronto region up there. You've been writing about this for many years about how strong the housing market's been there. What is your sense on housing in North America?
Well, I'd say it's an enormous bubble, and it's a bigger bubble than it was back in 06 and 07. And I'm not talking about subprime or even leverage. I'm talking really about a price bubble. So I think that you'd mentioned that the year-over-year trend peaked very recently at around 20% in the Case-Shiller. When I was pounding my fist on the table back in 05 and 06 when I was at Merrill, the peak year-over-year trend was 14%. 14. And the point I'm making is this: like, you look in Toronto. In Toronto, it takes 13 years of income now to buy a single-family home, which is unprecedented, and it's double the historical norm. In the United States, it now takes about 8.5 years of income. And even with the wage increases at the low end, this is up-to-date data, and maybe that'll continue. It's such a small part of the population, but whatever. It takes 8.5 years of income to buy a single-family home in the United States today, which is about 40% above the historical norm. So we're talking here about 2 to 3 standard deviation events. Now, Jeffrey had said that, well, this is all about low interest rates. And I would have said the same thing for the stock market. You could make that argument 12 to 18 months ago. But we actually wrote a whole report on this, where we found that even when you interest rate adjust housing valuations, we did the same thing in the equity market. It's the same conclusion. You can't use the argument anymore about interest rates being so low because the excess, call it return, or the excess of prices over income adjusted for interest rates for both equities, by the way, and residential real estate is around 20%. That is the excess over and beyond adjusting for interest rates are. So this is basically called speculation. We have a bubble in speculation in both asset classes. And let's see what the Fed does next year. They're barking, will they bite? We've only seen, this has gone parabolic. I mean, let's take the stock market, for example. Jeffrey mentioned the past 2 years, and we can exclude the top 5 stocks, but let's just say the market is the market. We can go to the NYSE if people aren't happy with the S&P 500. We can go to the Russell 1000 if you're not happy with the S&P 500. The S&P 500 is not the only index. The stock market's gone up 20% per year for 3 years. A typical year in a bull market is around 7-8%. We've done 20% per year. In 2019, the Fed cuts rates 3 times. And then in 2020, they cut rates 150 basis points and expand the balance sheet 80%. And then this past year, they expanded the balance sheet by 20%, which is almost a 2 percentage point decline de facto in the funds rate. They've just eased year 1, eased year 2, year 3. And we haven't even talked about we're just talking about the past. Inflation is a lagging indicator. It's a really big concern if it filters through in expectations. It's been very mild in that regard. Next year is a year of transition. And so what happens next year with all this excessive price action that we can nail down to Fed policy? Fed policy reverses. By the way, aggregate demand, where does that go with the fiscal drag? We're going to be seeing immense fiscal drag next year. What's that going to do to aggregate demand? But to me, it's like we've all talked about. Fed policy is going to be shifting. And you have to be thinking that the interest-sensitive sectors, and equities are interest-sensitive, most of it is, and housing is the most interest-sensitive sector that there is. So if the Fed's going to bark and not bite, well, we'll see. Something's going to stop them from raising rates. And if the something doesn't stop them raising rates, they're going to raise rates at a time when the yield curve is basically, the yield curve today is half the slope it normally is at this stage leading up to a Fed tightening cycle. They don't have to raise rates more than a few times to flatten and revert the yield curve. Let's see how this plays out. But we have excessive prices over and beyond where interest rates would justify in both real estate and in equities. And this is the big risk. The big risk next year is everybody on the panel is talking about their big wage and consumer inflation next year, which are lagging indicators, is asset deflation. If the Fed pulls the plug on this thing, and tell me we haven't seen this movie before. We've all seen it.
We've seen the movie repeatedly, and every time the movie plays, ever since basically 40 years ago, it takes less and less of a Fed funds level to make the economy buckle. I mean, the last one, it took only 2.5% or so. And my theory is based upon what's been happening in the bond market over the past several months, is it looks like it's going to take something like 1.25% to break the economy. And so
I don't know.
Rosie,
I don't know that they get there.
I completely agree that everything is balanced on these negative real interest rates. These are the most negative real interest rates we've seen, especially when you throw in the quantitative easing and the stimulative effect of that, which is another Atlanta Fed study by Wu and Shi that say that they try to do a thing like, let's pretend that we didn't do QE, but instead went to negative Fed funds. What would that negative Fed funds have to be to equate, and of course this is academic, so don't put too fine a point on it, but it shows that the Fed funds rate with the QE that at its peak, which is now diminishing, it was almost negative 800 basis points on the Fed funds rate, is where you, on the real Fed funds rate. And when that goes up, I mean, the one thing about the stock market, which I agree is loaded with speculation, as is everything. The one thing about it is if you keep rates where they are on, say, the 10-year, stocks aren't actually expensive by historical standards. But if that rate goes up, they become very expensive very, very quickly.
The terminal funds rate right now, if you go with the market's measure, is around the market measure is around 165, 170. The Fed's latest dots are around 250. So the market is thinking that the terminal funds rate is going to be much lower. Now, what is that? That's the rate at which they stop raising rates. But let's remember the history of the Fed. They are very, very skilled at raising rates too much and breaking something. So the market is kind of telling you that at the outset, at the upper end, about 170 will do it. And Jeff, you're right. 2 3/8 in 2019 broke the repo market. And before that, it was 4%, around 2007. So that number keeps coming down. And that's why I think that the take in the yield curve is Rosie mentioned, we're starting off with a yield curve half the level that we usually start off the yield curve with when the Fed starts tightening, is that I look at the long rates as not so much as being a metric of what do we think about inflation, but what do we think about the market, the Fed breaking something. And the signal that you've gone too far in the market has always been an inverted yield curve. And starting at 80-ish, 90-ish basis points, 2-year, 10-year, the expectation of 3 rate hikes, the Fed is under enormous political pressure to do something about inflation. So it's not just, an issue of, hey, we can't touch the stock market. We got to do something about these other 40%. Couple of rate hikes, a little bit of rally in the 10-year. You're inverted by the middle of the year.
I don't know why we have the Fed, frankly, because all that happens, I've got this campaign that I'm advocating that we replace the Fed with the 2-year. Because when the 2-year is sleepy down at 15 to 25 basis points, as far as the eye can see, we're not hiking.
We're talking Rand Paul.
2-year goes up to 75 basis points. Next thing you know, we're talking about tightening in 2022. We're talking about possibly 3 hikes from nothing. And why is that? Because the 2-year went up by the equivalent of 3 hikes. So 700 PhD economists plus at the Fed. I don't know if it's still that many. Jim Grant used to tell me that. 800 now. What a waste of money. You can replace all of them with a Bloomberg terminal following the 2-year.
They already have my Bloomberg terminal.
One of my many soapboxes.
Except for Williams.
That sounds like wage deflation to me there. Or maybe pedigree inflation.
When you think about the central bank's role historically, was the lender of last resort. And then what's happened is that we totally politicized the institution over the decades to include full employment mandates, to include their definition.
I think climate change is starting to bleed into their mandate.
It's all over the place.
Remember Humphrey Hawkins, when was that, 1978, that you had to traipse the Fed chairman in front of Congress twice a year to defend. Everybody's always talking about is the Fed independent? Well,
78, dual mandate.
So it's a presidential appointment that needs Senate confirmation. So how could it ever have been independent? But I totally agree with what Jeff just said, that the mandate of the Fed, they become their own political institution. That's what's happened over time.
All right, I think this is a good point to take a break for everyone. Let's refuel, recharge. To our viewers, we can just pick this up right from here. We're going to take a quick break, and we're going to jump right back into what does this all mean for markets. Stay tuned.